Lemonade is doing what it needs to do. I'm titling this video, Lemonade is doing what they need to do. It's about Q1 2023 earnings. I've had a chance to digest the letter a little bit more, update my model, and play with that a little bit. And so I want to share some more thoughts with you guys and updates from my model. First of all, Lemonade is doing what they need to do. They had adjusted EBITDA of about $50.8 million for the quarter, or negative $50.8 million for the quarter. And I had predicted, or was forecasting in my model, 46.7, so about 48 million, so a couple million off, but overall pretty solid because they were actually guiding for some $65 to $63 million loss. And if you remember some of my other videos, I tried to actually get to this kind of guidance. I just found it really difficult with the model, no matter how pessimistic I looked at it, but still trying to be realistic. And so that was what got me more to the $47 million loss range. And they actually did about $51 million loss. So much closer to what I was forecasting, which is really, really good, because if they were actually in line with their guidance and they were going to do, $240 million loss for the year, that's really bad news for the company long term. But if they're on this sort of trajectory where they're getting closer to $200 million loss maybe for the year or better, much, much better. That's really what I mean by Lemonade is doing what they need to do. A lot of the metrics are improving in the right direction, and it's really, really positive quarter for me. I'm very, very excited about this quarter. It even feels like it's a very, very positive step in the right direction. Really, really positive signs of great execution, all the details, all the sort of different factors that can compound their success, all sort of inching towards the right direction, and you're slowly kind of seeing where this ship could be headed. So for me, really, really excited by this quarter. So of course we had that guidance beat where they beat that $63 to $65 million loss quite handily. And for the year, they were forecasting $240 to $245 million loss. But now we have their updated guidance for Q2 is now $58 and $55 million range, and we have full year of $200 to $205. So a major reduction in the full year adjusted EBITDA, which is really, really great. And I hope, and I think I would even expect, because I was forecasting, I'd have to play with the numbers a little bit more going forward. I'll do some more videos on that, but more like maybe $180 million loss for 2023. So I kind of wonder if they'll continue to beat this guidance. Now let's look at the current model where I've changed or updated these values to reflect this current quarter. So we actually had a beat on in-force premium of up to $653 million. Again, they're forecasting about $636 million or somewhere close to that. So I have a pretty good beat on the in-force premium top line. Also still added 49,000 customers. So pretty impressive add for customers, considering they are talking about this year being really a slowdown year for growth as they wait for regulators to approve their price changes that they've requested, as they wait to roll out new products into more places, and as they fine-tune those new products, those bigger ticket products in more places, and continue to sort of take baby steps to fine-tuning their customer selection, customer renewal, selecting good or risky from less risky customers, and trying to improve the overall loss ratio in all those ways for those new products. So they're slowing growth, but still pretty decent growth here in this quarter. Of course, if you want to get full access to this entire model, you can do so by joining my Patreon. I will link that up above in the video. Really appreciate every single person who joins my Patreon. It's really humbling thing, and I appreciate your support. But you can also get a chance to see this whole model, so a huge benefit. Okay, so annual dollar retention moved from 86% to 87% this quarter, which meant there was 21% of customer churn from 12 months prior. So this is partly a function of how premium per customer is rising over the last 12 months, but also a function of the annual dollar retention. So they're all kind of combined. But I have 21%, so really, really good. This is a major factor, really important factor. We'll look at churn history. If you go all the way back to first quarter of 2020, they were at 40% churn or somewhere in that range. And then they were in the 30s for quite a while, over maybe a year and a half or so, 2 years in the 30s. And then they've been slowly trending down as they roll out more products in more places, as they get an existing book of customers that's been there longer, that are more reliable. This will continue to trend down. We're at 21%. It might actually trend up this year and into next year. In my model, I've been kind of playing with that if they push more into renters this year, we'll probably see this trend up a little bit. Temporarily, but I think long term, my thought is long term, this could be, maybe 15% customer churn annually churning away. Maybe even less than that, sort of in a long term scenario. But overall, sales and marketing was basically the same, 28 million of what they spent the quarter prior. If you think about all the customers that they churned, that they had to replace, plus the new customers sort of net total they gained, it would average out to about $222 per customer. So a little bit higher than expecting. I kind of think this number might go down this year as I assume to attract a renter is sort of a less competitive market, and you could advertise to and attract and get those sort of customers for a little bit cheaper than you could, say, auto insurance or other markets or other products. But 18% of gross earned premium is where your sales and marketing's at. Other insurance is, modest increase from 13.1 to 13.6. It's 9%. So all of these expenses have to keep trending down long term. Tech development was 7% quarter over quarter down, and it's now at 14% of total gross earned premium. So that's great. General and administrative up just 5%. So that's pretty good. 32.7. This total, let's see, I was at 96.3. You're kind of guessing on these, but I was at 92.7. So very close in my preview video I did before earnings. Now let's flip back to where we are now. Operating income of negative 65 million. I have 15 million of stock-based compensation. Actually, I think it was 15.4. Yes, it was. So I'll update that to 15.4 million. Slight change there. Cash on hand, they're at about 993 million. And I get about an adjusted EBITDA of about minus 50 million or so. Forgot to show you, though, the operating expense history. So I have expense history here, has trended down. This is all your expenses, blue line, as a percentage of gross earned premium, and we're down to 63%, which is what it was last quarter. They made comments, I believe it was last quarter on the call, if I remember right. I think it was Shai's comments on the call, or one of the answers to a Say question. He talked about how he really felt they were built right now to scale and growth. So you really would think your total expenses, let's just have a look at that. Yeah, your total expenses, which were 96 million this quarter, were 95 million the quarter before. So you would expect, as they really continue to grow the top line, even accelerate the growth, maybe not this year, but in future years of the top line, your total expenses here is going to have a much more modest amount of growth comparatively to that top line. That's where you get that operating leverage, and this should continue to trend down. How I've modeled it out, or at least what my model's showing right now, I keep kind of adjusting my model out into future years. But how I'm modeling it, we're right here at 2023 Q1, this little flat line, is that it continues to drive down all the way down to, in the vacuum, I'm at about 10%, even at the most extreme. Based on these numbers, if you look at where I'm operating income flips to being positive, I'm still around the year 2027. It would actually be a little bit sooner than this, because this would include stock-based compensation. But right around in there still, which is kind of where I was before, where I have them flipping to being actually profitable. I'll continue, though, to play with these numbers sort of on a longer term basis. I haven't had that much time yet here today to really flesh those out. Now we'll flip back to letter. Just want to highlight a few more things from here. Talk about loss ratio. I have this nice graph of gross loss ratio and gross loss ratio excluding catastrophic events. So both are trending down. This is from, let's see, Q3 to Q4 to Q1. So 94% to 89% to 87%. And without catastrophes are at 88, 79, 72. So even more significant. I've seen different insurtechs kind of put this sort of numbers in here, excluding catastrophe. I think it's interesting. I'm glad they do that. But at the same time, you still have to, an insurer is always going to have to deal with catastrophes now and going into the future. So this, they're never going to have this perfect scenario where there's no catastrophes. So you want to see the actual gross loss ratio going to trend down and have really great years and some bad years when there's more catastrophes. That's just the nature of insurance. Hopefully Lemonade, part of their strategy is they can grow big enough, large enough, even years from now, decades from now, where they could be a really global insurer. When I interviewed Daniel on my channel, I asked him if he ever saw Lemonade insurance coming to Canada. And he said, well, really, you could ask me that about any country in the world. And the answer would be the same. Like, yes, we will plan to be there. So they have really huge long-term ambitious worldwide goals that could help even out that sort of catastrophic risk across their book of business. They made a small improvement in their guidance for IFP for the year. They also talked about their adjusted EBITDA had a major shift from 240 to 205, 200. And again, I'm hoping that continues to come down. Right now, actually, for the year, my model is showing 181 million. So we'll see how that plays out. I'm going to probably tweak the next few quarters a little bit more in the coming days. And then they have this nice write-up about Lemonade loves AI, and how really Lemonade has been built and structured for a hyper-efficient organization where they have AI Jim, who can pay a theft claim in 3 seconds, and Shai wrote this blog post in 2017 about the rise of autonomous organizations. That's where he sees their organization going. And also another blog post, AI Eats Insurance, exactly why artificial intelligence will transform insurance and exactly how. Their vision of how AI not only provides superior service at lower cost, but will ultimately transform the core of insurance, quantifying and selecting risk. And then they talked about, this is exciting, that they've had LTV6 model. It helps predict for any customer, is taking as many data inputs as they possibly can, creating a model around each customer, and then from all that data for each customer, trying to predict their churn. How likely are you to churn? How likely are you to create a claim? And how likely are you to cross-sell? So then if they find a customer who's, and you'll see examples of like this in negative reviews for Lemonade, where people will say, hey, I had a claim for my, my house claim, or flooded something, or my renters, whatever it is, submitted a claim, and then immediately after the claim, Lemonade canceled my insurance. So Lemonade, their model said, you know what, this person, maybe they're on the line, maybe they're really risky to have claims again. And so we're going to actually cut them out, and we don't want them as a customer because we're not pricing them high enough for the amount of risk that they're creating. So, and then of course, even better, if somebody, a positive direction, whether someone's going to cross-sell, maybe they're a really good customer and they're going to cross-sell, and that's the kind of person you want that you can sell at competitive prices all your products to, and as they grow through life, they just keep adding more and more insurance products to their package, but they rarely are very, very unlikely, or less than the average person, of actually filing a claim or having something go wrong where they actually need insurance, because they're a very low-risk, responsible person. So they're creating these models around that. They have LTV6, they're moving on to now they're at LTV7, and LTV8 will be later on this quarter. So it's very cool to see they're built even in a way to rapidly increase and improve these sort of models. And jumping over really quick to my Twitter, I have a tweet pinned on the top of my profile. 3 main concerns for Lemonade: their loss ratio, their customer churn, and their operating costs are all too high, and they have to improve. And I kind of explain why each one should improve, and I think we're starting to see those improvements. And even their LTV models that we're talking about should improve continually the selection of customers, what they really want in their book of business, and customers they don't really want. And we've seen that in the past. Their loss ratio by product here, if we have home owners, it's dropping down from 132% to 117%. And pet is slowly tracking down. Renters is at 61% all the way to 55%. So really, really productive in renters. And they show this renters insurance several years ago, back in 2017, was once 161%, and it went all the way down to 79%. And now they're saying they're at 55% for renters, and they're sort of predicting at that time that they're going to have 51% just for renters. So how these improvements are driven by correct pricing in line, but also selecting the right customers and hanging on to the right customers and discarding or dumping the wrong customers. So that's what these models is really exciting to see these. And that's the point I've been making. This is the most important thing. The most important thing when it comes to insurance and AI is how correctly can we categorize a customer's risk profile? How accurately can we be? To know, is this person really safe? And you know what? There's a good chance they'll go the whole life, drive their car their whole life, have their home their whole life, and never have any car accident and never have any issue or claim or flooding or fire in their home. Because those are the kind of customers you want to grab, because basically every dollar of their premium just goes to the bottom line. Here's part of that potential profit. So your ability with AI to predict those sort of people or categorize them somehow more accurately is the most essential thing for insurance. And in my mind, Lemonade is built like that because they've structured and built themselves in a way to capture all that data and compare that data. There's other cool things like creating, LLM models where you can have more open-ended discussion with a customer, and it'd be interesting to see if Lemonade can utilize that in some of their chatbots, maybe even some of the more complicated sort of process streams, like say somebody's filing a claim and there's a lot more detail and back and forth discussion about the claim and what happened. Maybe they can utilize LLM bots and reduce their headcount and expenses in processing claims. Just like a lot of claims right now are already processed automatically by AI Jim, but that can only go so far. It's maybe half of the claims are done that way, but then the other half are still probably quite time-consuming and tedious. But they basically explain, yes, they're built for AI, they're using AI, and if there's new developments in AI that they can sort of plug and play into their business, they're definitely structured in a way that they can easily and quickly do that and even experiment with that, as they mentioned here in this section. Reinsurance is also really interesting. They are moving towards probably a 6-to-1 overall reinsurance strategy. They shared that at Investor Day. It says that right there back in November. That basically means for every $6 of in-force premium that they need $1 of cash on hand. So if they're at, 600, if they hit that ratio, if they had 600 million of in-force premium, they'd only need $100 million of cash and cash equivalents there. But that's what I got for you guys. It's really, really exciting to see this continued trend of in-force premium growing. It's really exciting to see churn continuing to drop down. It's exciting to see expenses continuing to at least stay flat and hopefully continue to flatten out. And also loss ratio. I should put a loss ratio as a graph on here. I will make that change. But also loss ratio continuing to trend down, at least slowly, in the right direction. And also exciting for me to see them hit close to the adjusted EBITDA I was predicting, and which is a major beat on where their guidance was previously. So Lemonade, in my mind, is doing exactly what they need to do. There's no question. They're really just marching down the path we need them to march down and executing towards the vision. I think we could see them eventually hitting, which for me, I'm seeing that maybe even in like the 2030s, they could be, $100 billion company or more. It's, theoretically possible in my mind. Thank you so much for watching. If you want to support the channel, I'll link again, join my Patreon and get full access to this model. Would really appreciate your support. And let me know what you thought of the quarter down below in the comments. You can also find me on Twitter at PaperBagInvest. Hit me up there. Thank you so much for watching. And remember, it's in the bag.